The everything bubble is about to burst. The system is flashing red. This isn't a prediction, it's a pattern recognition exercise. For the first time in modern history, nearly every single asset class, stocks, bonds, real estate, crypto, is simultaneously inflated to historic highs. They call it the everything bubble, and it was created by a single input, over a decade of cheap money engineered by central banks. That input has now been reversed. This video is your operational brief. We're not here to sell fear or conspiracy. We're here to deconstruct the mechanics of this system, identify the catalyst that will pop the bubble, and equip you with a tactical framework for the fallout. This isn't about timing the market. It's about understanding the environment so you can navigate it effectively. Let's begin.
The architecture of the bubble. To understand the fragility of the current system, you don't need a degree in economics. You just need to understand one core principle. For over a decade, the price of money was artificially set near zero. Think of the global financial system as a complex hydraulic network. Central banks control the main valve, the supply of credit. After the 2008 financial crisis, their objective was simple: prevent a total system collapse and stimulate growth. To do this, they cranked the valve all the way open. This wasn't a trickle, it was a flood of cheap, nearly free capital into the system. This policy operated through two primary mechanisms. First, ultra-low interest rates. When it costs almost nothing to borrow, it changes behavior. Corporations took on massive debt, not necessarily to innovate or build, but to buy back their own stock, artificially inflating its price. Individuals were incentivized to take out larger mortgages and use more leverage than would otherwise be logical. The cost of risk was suppressed. Second, a process called quantitative easing, or QE. This is a technical term for a simple action: central banks printing digital money to buy assets like government bonds. This directly injected trillions of dollars of liquidity into the financial markets. But this new money had to go somewhere. Now, here is the critical part. When safe investments like bonds pay you next to nothing, you are forced to seek returns elsewhere. This creates a psychological condition in the market known as TINA. There is no alternative. Capital that would normally be parked in stable, low-risk assets was forced into riskier and more speculative ones. It flowed into stocks, pushing valuations to absurd multiples. It flowed into real estate, creating bidding wars in cities worldwide. It flowed into brand new, unproven asset classes like cryptocurrencies and NFTs. The result is the everything bubble. Asset prices across the board became decoupled from their fundamental value, their ability to generate real-world cash flow. Instead, their prices became a function of a single variable: the continued, uninterrupted flow of cheap money. The entire structure is built on that one assumption, and that assumption is now invalid.
The catalyst event. A bubble this large doesn't deflate slowly, it pops. And popping requires a catalyst, a sharp, specific event that shatters market confidence. The primary catalyst is already in motion: the end of cheap money. For over a decade, the system was flooded with near-zero interest rate liquidity. That was the fuel that inflated every asset. Now, central banks are aggressively raising rates to combat inflation. The fuel is being systematically drained from the system. This isn't an abstract economic theory. It has direct, physical consequences. It makes debt expensive. Think about the thousands of companies that only survived by constantly refinancing cheap loans, the zombie companies. They don't generate enough profit to pay their own bills. They just borrow more to stay alive. When rates rise, that game ends. They no longer can afford their own existence. They will default. This also changes the fundamental math of asset valuation. When interest rates are zero, investors will pay almost any price for the promise of future growth. But when you can get a guaranteed 5% return on a safe government bond, that speculative stock with no profit suddenly looks extremely risky. The entire risk calculation for the market gets recalibrated, and the only direction for these hyperinflated assets to go is down. So the trigger, The specific pin that pops the bubble will be a credit event. It will be the failure of one of these major zombie corporations or a highly leveraged investment fund. It will be our generation's Lehman Brothers moment. The failure of one entity will force the market to ask a terrifying question. Who else is exposed? Who's next? That is the catalyst. It triggers a psychological cascade. The dominant market psychology flips overnight from greed to fear. The buy the dip algorithm breaks. It's replaced by a new command, sell any rally. Confidence doesn't fade, it shatters. Understand this critical point. The catalyst doesn't cause the collapse. It merely reveals the fragility that was already built into the system. The bubble is the vulnerability. The catalyst is just the final predictable trigger. The contagion protocol. This is where traditional financial advice fails you. You were told to diversify, own some stocks, some bonds, some real estate. The theory is, if one goes down, the others hold up. This is a fatal assumption during a systemic deleveraging event. When the everything bubble pops, correlations converge to one. This means everything sells off at the same time. The mechanism for this is not complicated. It's called a liquidity cascade. It's a chain reaction of forced selling driven by the need for one single asset, cash. Let's run a simulation. The first domino to fall isn't the entire stock market. It's a niche, over-leveraged sector. Let's say it's commercial real estate loans held by regional banks. Suddenly, defaults spike. Those loans, once considered assets, are now worthless. A fund or bank heavily exposed to this is now in critical condition. They get a margin call. They need cash, and they need it immediately. They can't sell their bad real estate loans because there are no buyers. So what do they sell? They sell their good assets. They liquidate their portfolio of blue-chip stocks, their Apple, their Google, their Nvidia. This is not strategic selling, it's a fire sale. A huge block of shares hits the market, pushing the entire index down. Now, the average investor logs into their account. They don't know about commercial real estate loans. They just see that the S&P 500 is down 5%. Panic is a powerful processing heuristic. It triggers herd behavior. They start selling too to protect their capital. This wave of selling creates more margin calls for other leveraged players. The cycle accelerates. But it doesn't stop there. People who just lost 20% in their stock portfolio feel poorer. They cancel plans to buy a second home. The housing market, which was already slowing, now faces a demand shock. At the same time, someone who needs cash to cover their losses decides to sell their Bitcoin. The contagion has now jumped from corporate debt to stocks to real estate to crypto. Every asset is being sold not because it's a fundamentally bad asset, but because market participants are being forced to liquidate to get cash. In a system-wide crisis, the only asset that matters is liquidity. Understanding this protocol is the first step to building a strategy that can actually survive it.
The operator's playbook. All right, let's talk strategy. Fear is a useless emotion in this environment. Panic is the enemy. The operator's goal is not to predict the exact date of the collapse, but to architect a system that is resilient to chaos and designed to exploit the opportunities it creates. This playbook is a three-phase protocol: fortify, recon, and deploy. First, fortify your position. Before you think about offense, you master defense. In a downturn, liquidity is not just king, it's the entire kingdom. Cash is not a dead asset earning 0%. It is a call option on every undervalued asset that will be sold by forced sellers in the future. Your first action is to build a significant cash or cash equivalent position. This is your war chest. It's your dry powder. Simultaneously, you deleverage. Debt is a vulnerability multiplier. In a bull market, it amplifies gains. In a bear market, it guarantees liquidation. Margin calls and high interest payments will force you to sell your best assets at the worst possible time to cover your liabilities. The operator deleverages before the crisis, not during it.
You need to run a stress test on your entire financial life. If your income drops 30% and your portfolio drops 50%, what breaks first? Identify that single point of failure and eliminate it now. Second phase, reconnaissance. While everyone else is panicking, you are calmly gathering intelligence. You build a watch list. This is a highly curated list of best-in-class assets you want to own at a discount. We're talking about companies with zero debt, massive cash reserves, and a durable competitive advantage. Companies that will survive an economic winter and thrive on the other side. You're also watching entire sectors, real estate in specific zip codes, or even commodities. You do the research now in the calm so you can execute without emotion in the storm. During this phase, you must aggressively filter signal from noise. The financial news will be 99% noise designed to trigger your emotional circuits. The signal is in the raw data: corporate debt levels, credit default swap spreads, shipping and manufacturing indexes, unemployment claims. You are looking for indicators of maximum capitulation, the point where the market gives up completely. That is your signal to prepare for the next phase. Final phase, deploy. This is not about timing the absolute bottom. That's a fool's errand. This is about executing a phased deployment of capital. You don't go all in at once. You deploy your war chest in tranches, 20% at a time, 30% at a time, as the market hits your predetermined price targets or signals of capitulation. This systematic approach removes emotion from the equation and protects you from deploying all your capital too early. Your mission is to find asymmetric opportunities. You are hunting for situations where the downside is limited but the upside is exponential. This happens when high-quality assets are sold for irrational reasons. Think of a fundamentally sound business being priced for less than the cash it has in the bank. This is what a liquidity crisis produces. The operator's greatest advantage is a long time horizon. Hedge funds and panicked investors have to sell. You don't. You can buy, hold, and wait for rationality to return to the system. This is the process. Fortify, recon, deploy. It's a simple, logical protocol that turns market chaos from a threat into an opportunity.
So that's the framework. This isn't about panicking, it's about upgrading your thinking. When you understand the architecture of the system, you stop being a passenger and you start becoming an operator. The transfer of wealth that happens during these downturns is not an accident. It flows from the unprepared to the prepared. Your mission is to be prepared. If you want more tactical breakdowns to build your strategic edge, subscribe to Capital Sanctum.